Congratulations. You are now welcome to try to launch this business. People can send money to themselves using banks. People can send money to themselves using PayPal. Why would they use your Neo Finance thing if they don't have the ability to do the payments that they need to do? The new reality. Licensing does not equal bankability. And there's so many founders, so many CEOs, so many new businesses out there getting financial licenses. It's new money, expansion of user friendly features is one of the greatest growth industries of the last 20 years. And especially in Canada, registration as a money services business didn't commence until the early 2000s. So it's still relatively young, certainly younger than me. And this was long before cross border prosecutions happened, bankruptcies, consent orders, theft of client funds, or at least all of those crimes done by financially licensed companies. So, money services businesses and regulated entities were no less risky in the early 2000s. They were just a little bit less widely licensed and a little bit less numerous. So in 2007, Payment Services Directive 1 comes out and it says, hey, man, I think if you're doing payments and you're facilitating the movement of money and all these kind of things, you should probably be licensed. You should probably have identification requirements on your customers. You should probably be able to identify yourself. And the government should probably know what you're doing. And payment licensing didn't even come to Canada until the trucker convoy during COVID moved the Canadian regulator Fintech to require licensing as a money services business for payment service companies, for crowdfunding companies, and the same requirements. You had to have a compliance program, you had to identify your customers, you had to keep records of those and make those available to regulators and everything else. So, new reality kind of applies in that licensing is young and in that it's relatively young in Canada. COVID was less than a decade ago. And even since then, in the last 3 years, we've had the Retail Payment Activities Act become proposed, come into force, and require all these payment companies to be licensed beyond being registered with the Financial Intelligence Unit, and the requirements of that licensing be a little bit more robust, a little bit additional. So not only do you have to identify clients, not only do you have to keep those records, make them available, report transactions, you actually have to have a framework for safeguarding your client funds. You actually have to have a map of how you do it, where it's stored. Ideally, it's stored in Canada. If it's not, it's stored in a bank that meets the requirements and would be easy to make your clients whole if you go under or anything like that. So the new reality is that this licensing regime in Canada looks a lot like former licensing regimes elsewhere in the world. And it's only new in that from a regulatory arbitrage standpoint, multiple businesses have been taking advantage of lower costs to launch and operate with a globally valid license. So even then, even after you become licensed in Canada or somewhere else in the world, you're licensed. Congratulations, you're licensed. That's amazing. Having some form of licensing just means that you were aware of the requirements. The requirements are public. You met the requirements, and your local regulator, regardless of what country it is in, has said, you know what, we're going to give you permission to try to run a business. You have our permission to try. You've shown us that you are baseline aware of a bunch of information that we make public and capable of operationalizing it in a business. Congratulations. You are now welcome to try to launch this business. And if you're buying a restaurant or opening a restaurant, permission to try looks like you bought an oven, you have a commercial space that's food safe. People tend to want food and will come to your thing. With a financial services business, it's like you've demonstrated your awareness of compliance requirements, you've demonstrated that you have the budget to meet them, and you've demonstrated that you meet fit and proper requirements. You're less likely to steal people's money. That's amazing. But that's a very broad baseline, and that's a requirement set that a lot of people can meet. So, what gives you permission to operate? What gives you the ability to move beyond permission to try, which is just because somebody says, hey, we're going to give you the ability to try skydiving doesn't mean you're successfully going to pull your chute and land without dying. So, what comes next? And in finance, in any form of neobanking and in any form of licensed financial services, the logical next step is, do you have the infrastructure that is required to effect a payment? And are you able to use it? Are you able to attract customers to it? Do you have it at such a price that you can either, undercut or remain competitive with the market? And do you have a feature set that is going to motivate users to use your account? Because with the market the way it is and with margins flattening everywhere, not only do you have to have some banking partner that is willing to also give you permission to try, but you also have to have the ability to try at a competitive price. So I don't want to be super doom and gloom and set a stage that is like there's this insane mountain to climb that you're never going to get to. But I do want to be super real about the fact that licensing is no longer the standard. Anyone with money and time and a lack of criminal history and a reasonable business plan can probably become licensed in multiple markets. So what comes next is, can you convince a partner to stand next to you in a press release? Can you convince a partner that you know what you're doing to the extent that they are willing to risk their licensing, their infrastructure, and their operability on being next to you? So, even when licensing doesn't equal bankability, even when you're saying, okay, I'm licensed, okay, I got a bank account, that's fantastic. You need a bank account to pay your staff. You need a bank account to pay for all the wonderful vendors that allow you to use their service to meet your compliance requirements or to give you a tech stack that allows you to settle funds or whatever. But even after you've done all that, that doesn't mean that the partner you have is viable. And that doesn't mean that the bank account that you've obtained is commercially viable, that allows you to compete or undercut other people in the market. And that doesn't mean that you have the ability to do the real key parts of finance, which is control underwriting, i.e., you are the party that is responsible for KYC. People are comfortable enough with your KYC practices that they're going to rely on them without triggering a ton of RFIs and alerts that bury you in overhead and hold all your payments. So, controlling KYC, controlling underwriting of clients, super clutch for you having an operating business. But secondly, do you have the ability to control settlement, and do you have the permissions to do a third party payment? In the remittance industry, I hope everybody knows what I'm talking about. When remittance is one person sending money to another person, and my big head is in the middle of flow of funds here, this counterparty is your bank. So if you don't have the ability to facilitate one person sending money to another person, what's the point? People can send money to themselves using banks. People can send money to themselves using PayPal. Why would they use your Neo Finance thing if they don't have the ability to do the payments that they need to do? Okay, you're licensed. Okay, you're banked. Do you now have the permissions to do what users are trying to do? For a PSP, for an EMI, they have to answer to their sponsor bank. For the sponsor bank, they probably have to answer to their correspondent, as well as the Ombudsman for Financial Services, the Office of the Superintendent of Financial, or other regulators. For the correspondents, they have to answer to, in some cases, the Federal Reserve, in some cases, mega global banks, and all of them have to answer to the same government that you answer to, and they're under much higher scrutiny because their volumes are such that, from a classic risk-based approach, where the greatest volume of transactions is probably where the greatest amount of dirt is going down and where the greatest amount of attention should be paid, because it's, I think, probably not humanly possible to review the amount of alerts that are generated by fraud prevention and compliance solutions out there, and probably not humanly possible for this to be done in a bank. You have a lower number of analysts than you do alerts. And even with all the noise that's being made about AI, taking some of this off, AI is still trained by humans, and AI still makes the same mistakes that these analysts make. So you're licensed, you're banked, you're aware of everything that's in the chain. But now you need to be aware of what your bank cares about. You need to be aware of how to exit misalignment between licensing bodies and sponsor banks. And I said earlier in this segment or in this set of videos that the license is permission to try. But permission to try doesn't mean that you have everything that's required to make a good try of it. So licensing says, hey, You have to have a credible compliance officer. They have to be independent and have resources to manage your program. Undisputed. You have to have policies and procedures that are clear, that tend to make it easy for your staff to be aware of their responsibilities and how to meet them. Super basic. You have to have a risk assessment for your business that tends to identify the vulnerabilities and makes plans to control against those or avoid the risky behavior. You have to have ongoing training for your people, and you have to audit it. Like, that all makes sense. And all that stuff is assessed during a banking review or during a banking application thing. But what doesn't get assessed at the licensing point and does get assessed when you get banked is, how easy is it to run your program? How readily can you provide the information that you're required to have and provide? How readily can you provide it to your bank? How easy is it for your bank to rely on you, get the information required for them to protect their relationship with their regulator, with the other banks that enable them to do business, and how much are they risking with their entire global business of lending, perhaps issuing credit cards, transaction fees on people's saving, borrowing, and hopes for the future? How much of that are they willing to risk on your little fintech? It's likely not very much. Simply being licensed is no longer good enough. We're living in a world where, and I've seen this personally on the job, where wealthy people will buy or form entities that have some form of financial license, almost like a vanity item, also almost like they would have a Birkin bag. Where in the news that oligarchs or global multinationals that are semi-illegal or outright illegal will set up their entire own payment companies to move their own money around and facilitate the purchase of high value assets, or them doing sanctions avoidance, or whatever the case might be. We're dealing with a flattening of the accessibility of these things, and not in any way because the regulatory requirements are lax, but more because information is public. People are able to demonstrate this, and compliance is a growth industry. So you have tons of people like me out there that are selling the ability to go meet these requirements, and selling the experience of how to get these licenses and how to act as a fit and proper person, and so on and so forth. So there is a democratization of access to licensing, right? But there isn't a corresponding democratization of access to banking. And I've talked about this ad nauseum, how your bank doesn't want to risk their profitable business on your business, which is likely to be very not profitable for them in the short term. So once you have your license, once you have that permission to try, and even once you have your bank account, you have to then prove on an ongoing basis, you have to prove almost daily that you not only know how to keep both these things, but that you are prioritizing keeping both of them. So not, oh, I wrote or bought a great KYC policy and I pay a vendor and I'm vaguely aware of where my KYC is stored. Not, oh, I have a reporting integration and I test it every 30 days and I'm vaguely aware of the number of transactions that I do, loosely matching the number that are reporting. That simply won't cut it, and probably hasn't been able to cut it for several years. There have been some regulatory headwinds. The environment is getting far more hawkish from a demonstrate that you're compliant standpoint, solely because that's just how the world is. That's how it's going all over. But what are you actually doing to ensure that you're in control of your data? Oh, it's sitting on a server in Luxembourg. That stinks. If you don't actually store it yourself, if your KYC provider goes bankrupt or suddenly demarkets you and you have no access to all the customers that you've identified over the last 3 years, what are you going to do? Are you going to sue your KYC provider? If you're not storing this stuff yourself locally already, you definitely don't have the money to sue your KYC provider if they change and demarket you or whatever. And your founders aren't even prepared for this. They're sitting out there being like, yeah, I think it's on a server somewhere. That's great. You're not really looking at these questions. You're not really ready to keep your license. You're not really ready to keep your bank account. But I think we're talking about regulatory arbitrage here. So I think a lot of the questions are, is there anywhere left? Is there anywhere left to go where these kind of regulations don't apply? Is there any true regulatory arbitrage available? And just because the floor got higher doesn't mean that the ceiling got lower. In my opinion, there's still plenty of deltas between jurisdictions and plenty of ways for founders to launch in cost efficient ways. But that actually means that the absolute bottom of the bucket got wiped out and will continue to get wiped out. I think everybody, at least in Canada, at least in the Canadian landscape, has seen that FinTrack is revoking money services businesses every week, is posting administrative monetary penalties every week. So I think like the floor of that market and that landscape has been significantly elevated, and I'm happy to see it. And I think a lot of our clients are happy to see it, and certainly a lot of the banks that we work with are happy to see it, because it's not a criticism of the industry and it's not in any way a criticism of the world. It's a statement of fact. There's a lot of operations that do similar things to what my organization does. And they might sell the same policy template to every client, regardless of their underlying business, and with no accompanying tech stack and with no labor to augment it, with no server space to store these things for the client, and no real ability to do anything institutionally for their clients. And this is polluting the market, increasing the risk profile, and limiting access to banking for the good ones further. So what's a checklist of items? If you're a person out there that doesn't know this stuff, you're looking to enter this market, you either have infrastructure or you've solved for a novel need and you're going to attract users. What's the actual checklist of things that you need from your banking partner in order to go live and go live well? So I think you need an ability for your license to be able to cover on and off ramping to crypto. We're living in the stablecoin era, and I think that stablecoins are replacing legacy payment rails and allowing a lot of businesses to access incredibly rapid, low cost cross border settlement. I hope that anyone watching this video would agree with this and understands that the ability to do this is critical. We have countries where financially licensed entities struggle to access international fiat transactions in relevant currencies. Either they can't do it at all, or in the case of Canada, they can only do it in Canadian dollar, which increases overheads, means you have to operate a Canadian dollar account on the other side, pay Forex if your clients aren't all Canadian, and so on and so forth. On and off ramping into stablecoins at a low cost means better settlement times and more relevant currencies for the founder. Beyond this, the ability to conduct third-party payments, the ability to send money to one person on behalf of another person is absolutely critical. This is every bill payment. This is every remittance transaction. This is every payment for goods and services. Because again, if you're just paying yourself, why would you need a third party for that? Why would you need any tech platform in order to just send yourself money? Banks love it when you send yourself money. It stays in the banks. Beyond the third party transactions and the ability to on and off ramp, do you have the ability to hold client funds, and not so you can do discretionary trading, not so that you can float those balances on short-term futures markets, not so that you can gain lending revenue off it, but so that you can decrease friction for the user. So anytime I'm going to pay for anything or anytime I'm going to send money to another person, it's amazing if that journey starts with money in the account I'm using to send it, not me funding something and then sending it over here. Nobody wants to wait for anything anymore. Even with my knowledge of finance, we're living in this modern era where all these services want you to believe that everything's incredibly AI powered, incredibly technical, and incredibly fast. It's not the case. Lots of finance stacks, lots of banks, tech stacks haven't been updated in 30 years. And that's why we're also living in a golden age of hacks. But that's a topic for another day. The fact is, if you have less legs in your flow of funds, you're going to have faster settlement, you're going to have happier users, and you're going to attract more users. So if you can't do a third party payment and you can't hold a balance, I don't think you have a viable payment company. Beyond all of these things, the only things remaining on your checklist is, do you have a direct relationship with your bank, or are you intermediated? And we've done analysis for institutional global payment companies. The fewer steps between your customer's bank and your end bank, and the fewer steps indeed between your customer and you, the faster the transaction. the higher the acceptance rate and the lower the incidence of compliance or fraud reviews that trigger delays, upset your customer, and make you less viable. Beyond all these, I think we've arrived at the natural endpoint, which is, can you survive an audit? Are you aware of how to prove you meet your requirements? And are you aware of how to keep your bank happy, keep it allowing you to transact, and keep your business viable? So, what are the regulatory nooses that are tightening out there, and what's making it more and more difficult for these businesses to launch? And not eliminating regulatory arbitrage, but again, raising the floor, safeguarding of funds. Everything is getting super official with this. So not only are you aware of safeguarding procedures, and years ago, there were three ways that you could meet safeguarding requirements in the UK: insurance, daily reconciliation, or a safeguarding account. So this allowed for lower costs to enter the market and allowed for operators to say, okay, I can't really afford a segregated safeguarding account, or I don't want to, but I can afford insurance. Can't really afford insurance, but I definitely have an accountant on file that can do a daily reconciliation, and I can get all that done in that way. Now, safeguarding is getting a little bit tighter because, of course, people have insurance, but they may not pay the premiums, or the insurer might not pay out either, or the insurer might claim they were never aware of the underlying business. Then you have daily reconciliation, but who cares? If it's all in an account that isn't protected, and or the balances exceed creditor protection and deposit insurance, that leaves a lot of people wanting. So the safeguarding flows almost all are getting pushed to, do you have a dedicated and segregated account? And can you prove that you use it? So how do you earmark funds for safeguarding? Who can access them? Where are they stored? And is there adequate creditor protection in the trust account governing it? There's pressure on the third party models. We're getting all of the banks saying, I'm uncomfortable with nested risk. I'm uncomfortable with fifth or sixth party transactions, because you have correspondent bank, local sponsor bank, EMI or PSP, MSB under the EMI or PSP, and then you're getting close down here to the actual true beneficiaries of the transaction, but that might be a third party transaction too. Meaning, for the correspondent bank that was at the top of this illustration, that might be an eighth or ninth party transaction. So that's why there's all this pressure, is because these banks don't want to lose their licensing. They don't want to lose their ability to move money internationally at the speed of light for massive transactions that far dwarf your small business. And it's an age of crypto scrutiny. We're definitely, if you didn't think we were, I guess you're hearing it from me, this is a bit of a bear cycle. And we're seeing these kind of signals on how willing people are to take risks on crypto businesses. And we're also seeing tightening of which stable coins are allowed to transact in certain jurisdictions. So when you're looking at the landscape of regulatory arbitrage, and when you're looking at that landscape of what are the things that make forming this business viable, if you're looking at all of these tightening nooses, it might be pretty daunting for you. Beyond those things, if you look at how the bank is going to manage you, and if you look at how, I hope you have some experience of how you manage your counterparties and your clients under you, KYC is fine. KYB is fine. There are market leading vendors out there that collect all the necessary documentation for you, validate it for you, and store it for you. And I've hinted a little bit that you should be grabbing that stuff on your own behalf and storing it on your server so that you have it in case one of these SaaSes gets wiped out by an AI KYC solution, which is probably on the horizon, right? A lot of these KYC providers exist on VC funding and store everything on their server with your access on demand. Probably at least one of these is going to go belly up. So you should be storing records of what documents you collected, how you validated them, and where they are that isn't exclusively on that provider's server. It's a little tip for everyone out there. But beyond all that stuff, KYC, KYB is fine. We're all using an accredited software vendor. What does that mean for managing your relationship with your bank? Because if you're just like, hey, man, I know I needed to identify them and I did, who cares? Why are they using your service? What is the source of funds for it? If they're an ongoing client, what's their underlying business that prompts them to do transactions of this size to this counterparty on an ongoing basis? And if they're only on ramping it into stablecoin, are you aware of where it goes after that? Is it all going into scam platforms that take advantage of elderly people? Is it all hitting cross-chain swaps? Is it all going to sanctions adjacent corridors or exchanges that don't have travel rule solutions? Like, where is it truly going, and do you even know? And does your model track for these red flags to enable you to say, okay, not only am I aware that I have nested party risk, not only do I manage it, but I can also present a credible narrative to my benevolent banking partner that, again, allows me to go beyond the level of permission to try. And the last, I think, regulatory news that is tightening is, of course, cross border transactions are all becoming much higher scrutinized by traditional banks because governments of the world need money. They're concerned that there's capital flight. They're concerned that skilled workers are leaving. They're concerned that they're losing their tax base, and they should be concerned because they are. The ways that money moves is, of course, being scrutinized much on a much higher level. And it's not just because the governments of the world all need money. Every single government of the world is operating at a deficit, but it's also because all of these banks are aware that what's drawing the most attention to them is what the government cares about. So they have to be able to examine the ways that money moves, determine whether or not it's eroding tax bases and depriving governments of revenue, determine whether or not it's exposing economies, entire economies, to illicit flows, to crime activity, and thus making the GDP either fruit of a poisonous tree or very vulnerable to getting wiped out. All of these things are impacting your remittance app, your crypto exchange, and your ability to operate. And again, if you think that it's just, oh, I got a license and I'm ready to go, I think that there's a hard road ahead of you that is fraught with all of these realities. We've talked about this point ad nauseum and we'll continue to talk about it. Your sponsor bank is what guarantees that you're able to do business. Having multiple of them means that you're insulated from any catastrophe event. And what are all of them looking for? Do you create audit risk for them? Can they represent that your flows of funds are largely vanilla? The parts of it that they don't understand, you're responsive of. And the parts that they do understand, they are so confident in what you're doing that they're willing to rely on you and allow you to control underwriting and settlement. The two most relevant things to control when you're running a finance business. How does your KYC AML program match to theirs? And does it go beyond just KYC, KYB? Are you training your employees on new typologies? Are you looking for violation of your hospitality and corruption policy? Are you looking for vulnerable people to that might accept bribes or other inducements, such as I think that guy from TD that did all that cartel money laundering did it for 7 grand in Amazon gift cards? Does your program even begin to codify that stuff, much less test for it? And are you profitable? Are you representing such an increase in overheads for them in transaction RFIs, ongoing reviews, the need to track every single one of your transactions and offset some of those costs by getting more software, upload all your wallets to their Chainalysis, Elliptic, or other forensic tool? Are you increasing costs for them? And is the attendant increase in costs worth it? So are your wire fees there? Are you giving them minimum balances that allow them to increase their lending portfolio? Is your transaction throughput so great that the traditional fees that they charge tend to make your relationship profitable? And if they aren't, you're not going to last very long. And how does everything present? So what happens when they get an RFI from their bank that just says, hey, PSP, EMI, somebody that relies on us for correspondent access to international USD wires, we're super concerned about all this crazy stuff we're seeing. We think it's probably isolated to one client. What do you know about that? And how easy is it to fill in the gaps? How fast can you do it? And does any of it match to what you told us when you applied for account? Does any of it match to what your nested counterparty told you when they applied for an account? And at the end of all of it, are you willing to stand next to this person? Would you be in a photo with them? Would you be in a headline with them? If the headline was negative, would you defend them or burn them? There's only a couple options. Everything moves super fast. News cycles don't reset quickly enough for these things to be ignored. The high risk activity that's going to break you, the high risk activity that's going to shut your business down super, super fast. And we actually are still seeing some of this stuff when we do effectiveness reviews and audits, which if I had any hair, it would get curly. But third party payments without licensing, without permissions, just hoping nobody notices, there's no defensible narrative. You simply cannot operate in this way any longer. You simply cannot say, okay, I have some form of licensing that kind of addresses it, that kind of covers it. I don't really expressly have permission, and I'm hoping that you're going to risk it all for me to do this activity at these low volumes. If you're doing third party payments without a license anymore, if you're attempting to kind of bamboozle someone with some contracts and invoices, that's trade based money laundering. At the end of the day, that's trade based money laundering. False invoices is one of the oldest money laundering typologies out there. I don't care. I'm not willing to entertain any other explanation of this activity. I have spoken. Banks and other entities are on high alert for high risk activity like under licensed iGaming, like adult content, like foreign exchange and crypto scams. Almost every government in the world has made some statement about pig butchering, has made some statement about all these funds flying out of their countries under these romance scams or false exchanges or fake investment or straight up calling people and intimidating them into going to a Bitcoin ATM or an exchange, buying crypto, buying a stablecoin, buying Bitcoin, sending it into this fake exchange. In some cases, there's false returns. In some cases, there's tax withholding schemes. Whoa, you made it big on a meme coin. Please pay the taxes. We'll pay them on your behalf and then we'll release your winnings. All these scams are still out there and everybody's on high alert because, of course, there's huge astronomical amounts of money leaving local economies and also just ruining people's lives just beyond the numbers. There's tons of heartbreak, there's tons of financial loss, and there's everything that comes with it after, which is addiction, suicide, stress on financial systems, and people losing loved ones. This high risk activity, it goes beyond whether or not your business lives or dies, but this is what banks are looking for. This is what governments are looking for. And if your flow of funds appears opaque, or you don't even know about it. How can anyone else trust it? If your underlying customers appear to be shells or nominees with questionable actual operations, or you're exposing your partners to this kind of activity, it's over. Again, it's trade based money laundering, and you won't convince me otherwise. And economies are being weakened by these pig butchering scams. Economies are being weakened by capital flight. And you're still seeing some banks that had headline risk, had exposure to pig butchering scams, never having recovered their position in the industries that they work years for because one careless headline. Major US banks that are, and major Canadian banks, in fact, major banks in every country, that in every instance a customer gets scammed, goes into them, sends money into a fraud scheme, loses their money and files chargebacks. These top five tier one banks don't get named in these headlines and don't lose their businesses. It's the offshore ones, it's the tier two ones that have a little more tenuous grip on their financial infrastructure. They're more likely to take risks on MSBs and they're more likely to get wiped out by this type of exposure. So if your program doesn't address it, doesn't even begin to tell your staff how to identify it and respond to it, it's probably over for you. And with crypto forensics, I think, again, we're in the stablecoin era. We're still seeing these unicorn companies that add stablecoin to their name and then sell at 10 to 100x their valuation into some VC structure, which maybe I'm in the wrong line of work. Maybe I should be doing this. But if you don't have a crypto forensic solution, if you don't have the ability to map your crypto exposure and then, of course, decide what's high risk and what to shut off. Last point is corporate structure in the modern age. The true new reality, how should I be if I'm a founder just starting out, or I'm a multi-business founder that knows a couple things, but maybe doesn't know everything. So it's like, how should I look at structuring my new business? And we get people all the time that either have money and have a product and are doing it for the first time, have money and have a product and did it before, but they're a little bit rusty, or have money, have a product and did their last business very recently, but want to leverage fractional partners to cut costs, increase efficiency, and allow them to focus on other things. So we get this question all the time. How should I structure it? How should I do it? Where should my company be? Where should my license be? What license will allow me to do this at the lowest cost of setup and maintenance, yet allowing me to access institutional banking partners that'll enable me to be competitive based on pricing? So when I first started in this business, I started managing acquiring bank supply for a number of pre-licensing payment providers. And it was back then, it was barely an industry. There was probably under 100 of these things globally, and managing all of our flows and ensuring that our banks understood us and would continue supporting us, allowing us in turn to support our merchants and do all these global payment flows. There's a number of rules about how you structure your supply and how you structure where things get routed. So one is classic 80-20 rule. These banks would say, okay, I can take 20% high risk, but I have to offset it with 80% low risk. And I think you should be applying that to your customer base regardless of what type of business you're in, right? So if you're a remittance business, you want to take as much vanilla flows, people sending money to their daughter or son to pay tuition and go to school, temporary foreign workers or immigrants sending money home to support their families. These are flows of funds that have incredibly low chargebacks and very defensible narratives and sources of funds when you're talking to your bank, enabling you to maybe support some higher risk business on the other end. And we've seen risk profiles for crypto businesses go way down if you set aside retail fraud and pig butchering, to the point where a crypto business might be able to fit and sit in that 80% of low risk volume, enabling you to go to that other 20%. And when we were structuring the card acquiring stuff, almost everything is payments, by the way. Almost everything is payment supply, and almost everything is determined by how much payment supply you have and how intentionally you use it. In card acquiring, if you only had one supplier, you're cooked, it's over. If that bank either decides that, hey, you're no longer in their profitable 20% and you're not offsetting it with enough low risk, you're gone. They've changed their acceptance policy, and regardless of how profitable it is, they don't want to appear in headlines anymore. You're gone. So you have to structure that redundancy in there, and you have to manage those flows in a way that keeps that 80-20. And when new clients are coming in, when new sub customers for you are essentially coming into your living room and putting their feet up, there has to be some kind of probationary period. You have to control the amount they're transacting, either from lump sum or rolling amount limits, or velocity, or both. These are the oldest controls in the world, and we're seeing people not apply them to fiat methods because they're not concerned about credit card chargebacks. But it doesn't matter if you get a bunch of wire chargebacks, the net effect is the same. You're going to lose your bank account. All that stuff, let's say you solve for all that stuff. You have multiple banks, you're structuring your risk profiles, you're qualifying new customers on channels that don't threaten where all your core repeat customers go. Amazing. Congratulations. You either listen to me, or you're smart and experienced, or maybe both, or there could be a mystery third path. Who knows? But let's say you've done all that, you can start optimizing for payment acceptance. So sending banks or issuing banks of credit cards are more likely to honor payments based on how they're coded, where the receiving bank is located, and so on. So you might make it this far. You might have taken advantage of regulatory arbitrage. You might have the ability to do third-party payments in crypto on and off ramping. You might have multiple banks, and you might be structuring your risk flows and customer acquisition properly. Now you can start doing the cool stuff like acceptance that enables you to increase your payment volume by 10% simply by looking at what's in front of you and answering those questions. But the actual question can no longer be what's the cheapest license I can get in the shortest amount of time possible. The actual question has to be, how can I do this intentionally? How can I launch quickly, iteratively? And then how can I build something that doesn't suck over time, that I'm not only proud of, but that is super defensible for my partners?